Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of the money world without making your eyes glaze over. Today we're diving into the RiverNorth DoubleLine Strategic Opportunity Fund's latest report, and let me tell you, this one is a juicy one filled with a whole lot of numbers that could mean big things for investors. So what's the big story here? This fund is playing in the big leagues of finance, managing a massive portfolio with a lot of moving parts. We're going to break down exactly where their money is, how they pulled in nearly $30 million in investment income, and yes, we'll cover the risks that come with playing in this complex financial playground. Stick around, because this report has some serious insights. And before we dive in, if you appreciate getting straight insights from these corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we discuss these filings and more thought. Let's get straight into the numbers. This fund is basically a fund of funds, meaning it invests in other funds to get its returns. They've got a busy year under their belt, raking in almost $30 million in investment income, specifically $29,650 $49,650 $346 and $40.46. That's in interest alone. That's a huge number, and it shows they're making their money work hard, likely through a mix of different investments. Now, earning that much money doesn't come for free. Their total expenses for the year amounted to over $6 million, $6,025,186 nels to be exact. The biggest chunk of that, over $3 million, went to the investment advisor RiverNorth Capital Management LLC. This isn't unusual for funds like this, but it's good to see where the money is going. When you look at the bottom line, after all the income and expenses, the fund's net increase in net assets from operations was over $23 million for the year. That's a solid performance, but remember, this number reflects profit before distributions to shareholders. Now for the part that really impacts shareholders directly. The total annual expenses, assuming they use a good amount of leverage, come in at a hefty 540%. That's a big bite out of your potential returns. To put that in perspective, if you invested $1,000, you'd be looking at paying about $54 in just 1 year in expenses. And that's with a conservative estimate. Hold on, because this fund isn't just dealing with common shares. They've got preferred shares too, and these guys have priority when it comes to getting paid. They have Series A, Series B, and Series C preferred shares out there with liquidation preferences that add up to over $120 million. That means if things go south, these preferred shareholders get paid back first before common shareholders see a dime. Let's talk about what they actually own. Their total investments are valued at an eye-watering $335,700 and $221. The largest piece of that, weighing in at over $67 million, is in non-agency collateralized mortgage obligations. These are basically complex mortgage-backed securities, and they carry their own set of risks, which we'll get to. They also have a massive chunk, nearly $61 million, invested in small business loans. These small business loans are rated as level 3 assets. Now, what does that mean? It means they're valued using methods that are based on estimations rather than readily available market prices. The report says they use a loss-adjusted discount rate and a projected loss rate. To figure out their value, a higher loss rate means the value goes down, and a higher discount rate also reduces the value. It's like trying to guess the price of a house when you can't see it directly. You have to make some educated guesses, and those guesses can significantly impact the value. Now, for the really interesting part, the risks. This report is packed with them, and for good reason. They mention investment and market risks, which is pretty standard, but then it gets specific. They're heavily invested in fixed income securities, which means rising interest rates are a big concern. If interest rates go up, big concern. If interest rates go up, the value of those fixed income investments usually goes down. They also have a huge exposure to mortgage-backed securities worth over $130 million. The report spells out prepayment and extension risk, meaning if interest rates change, they might get their money back sooner than expected at a lower rate, or later than expected potentially at a higher rate, which can mess with their returns. There's even mention of subprime mortgage risks, which we all remember can be pretty painful. They've also got over $21 million in collateralized loan obligations, or CLOs. These are complex financial products, and the report highlights that the value depends heavily on the quality of the underlying loans and the specific tranche of the CLO. And get this, they're also investing in SPACs, or special purpose acquisition companies. These are essentially companies with no operations, created solely to raise money to buy an existing business. The risks here are that if they don't find a good company to buy within a certain time, they might just return the money and your investment could be stuck or even lost. And What's a fund like this without leverage? They've consciously used leverage, meaning they've borrowed money to amplify their returns. This can be a double-edged sword. The report states their leverage represents about 36.85% of their managed assets. While leverage can boost returns when things are good, it can also magnetize losses when things are bad. This means when the market moves even a little bit, your investment can swing much more dramatically. For example, if the market drops by 10%, their common shareholders' return could be hit by almost 19% due to leverage. On the leadership front, J. Wayne Hutchins is a director and has been since 2018. His background includes being a trustee for the Denver Museum of Nature and Science and a director at AMG National Trust Bank. He also serves on the board of Alpia Series Trust. Then there's Patrick W. Galley, the interested director, chairman, and president. He's been with the fund since 2016 and is also the CEO and Chief Investment Officer of the advisor RiverNorth Capital Management. He's got a ton of experience in investment banking and portfolio management. He's got a ton of experience in investment banking and portfolio management. He's also oversees a large number of other investment companies. Looking at the overall trend, the fund has managed to stay profitable, with net investment income around $24 million this year, which has actually increased slightly from the previous year. However, their net realized and unrealized gains and losses have taken a hit, showing a loss of over $1,300,000. This indicates that while they're bringing in income, the actual value of their investments has decreased. And as we saw with those preferred shares, their total annual expenses when you factor in dividends on preferred stock jump significantly across the board. For common shareholders, this means a large chunk of the fund's earnings are going towards paying off these preferred obligations. Okay, so what's my take on this? RiverNorth DoubleLine Strategic Opportunity Fund is definitely playing a complex game. They're generating a good amount of income, which is great, but they're also taking on a significant amount of risk, particularly with their heavy investment in non-agency mortgage-backed securities and small business loans, which are somewhat opaque in their valuation. The leverage they employ amplifies both potential gains and losses, and the presence of preferred shares adds another layer of complexity and priority claims on earnings. While they've shown resilience in generating investment income, the recent losses in unrealized gains and the high expense ratio, especially with preferred dividends, are definitely things to watch. The fund seems to be navigating a challenging market environment, but the level of risk taken, particularly with those level 3 assets, means it's not for the faint of heart. Alright, that's our breakdown of the RiverNorth DoubleLine Strategic Opportunity Fund's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.